Hello everyone, and welcome to TBR's webinar, Finding Growth in a Shifting Applications Market, with TBR Principal Analyst Geoff Woollacott and Analyst Kelsey and Meaghan McGrath. I'm Justin Sargent, and I'm hosting today's session. The shift of application consumption continues to favor cloud deployments, requiring traditional vendors to enable cloud consumption and differentiate from competitors. Traditional applications vendors fight to maintain and grow market share and revenue streams in a software market undergoing drastic delivery model changes. To spur growth, vendors supplement their current offerings with rebundled solutions that solve specific industry or line of business pain points and acquire features that enhance the functionality of their solutions. Today's webinar will share insights found in our application software benchmark. If you'd like to learn more about this report, please reach out to myself or one of the analysts after the presentation. Before we begin, there are a few housekeeping items I'd like to cover. First, we'll be recording today's session and posting it on our YouTube channel, TBRI channel. We encourage you to visit our channel to watch this presentation or any of the others we've posted. Second, we'll be taking questions from the audience. Please send them to the Q&A function, and we will address them at the end of the webinar. And finally, we will follow up with everyone within 24 hours at the conclusion of the event with the slides from today's webinar as well as the link to that recording on YouTube. So check your email tomorrow afternoon for that information. Now let me introduce the analyst presenting today. Geoff Woollacott is a principal analyst in TBR's software practice and oversees the syndicated research team for the software and BI service practice. Meaghan McGrath is an analyst here in TBR's software practice and is responsible for analyzing the software and cloud businesses of vendors including SAS, Oracle, Amazon, Google, Rackspace, and ServiceNow. And Kelsey is an analyst in TBR's cloud practice and contributes insight for quarterly benchmarking activities comparing the industry's top performers. And with that, let me hand this over to the analysts.
Thank you, Justin. I would just add, too, that Meaghan and Kelsey work both in the software and the cloud practices. As you would imagine, there's a lot of overlap to the technologies and topics that we cover there, and they work within both groups as we collaborate on the various initiatives that are going on. So what we'll have today, the first thing we'll do is we'll take a quick look at some of the enhancements we've made as we stated when we began the transformation of these benchmarks 3 quarters ago. We're going to continue iterating on that. We welcome feedback from you folks in terms of things that you like within these, things you think we probably don't need to cover, and any net new information you may want. So we're always iterating on these things to better inform the market as we go. We'll give you a little bit on that. Then we'll go into what we call the overarching themes. We'll give you an idea of what have been the financial results that came out of 1Q15, then some of the key topics that we think are particularly timely. After that, we will go into the bubble charts that we're known for to take a look at the revenue, and then lastly, we'll go through some vendor highlights and scenarios. We have 3 topics today that we will be addressing. So this is the only paid ad that we have. This is a look at the portfolio coverage we have from the software side. We also have a slew of cloud companies we cover under the cloud practice. This is the application software vendor benchmark. That is the second one that you see on the right-hand panel. The top one is our infrastructure management software benchmark. We delivered a webinar on that yesterday. If you're interested on that, I'm sure we can forward you the link. And then below that is a BI software vendor benchmark, which has a lot of much smaller firms than we cover in the application software benchmark, and is one that is showing a lot of activity, and we will be updating that in the next quarter. As far as the content enhancements go, we added a new vendor, Splunk, into the application software vendor. We had to remove Actuate, which was acquired by OpenText. On the bubble charts we've added, you'll see it, it's a gray bubble to give you a scale perspective for the size of what the bubbles are addressing. And the other thing we did, if you're a subscriber to the report, the Excel spreadsheets we provide with the employee metrics, we've aggregated the IM and applications revenue pieces. We have not been trying to disaggregate the headcount, say, of sales between who's selling applications and who's selling infrastructure management, particularly if they cover the broad portfolio and they have both in their quiver. So just for a cleaner view of these things, the metrics that we provide in the spreadsheet goes to that. And then lastly here, as you see, we're always looking for the subscriber feedback, both in terms of the content and the format. So with that, let's get into what happened. It's pretty much the same as 4Q14, except it's accelerated in the wrong direction, meaning the trend that we have seen and expected has exacerbated. Top point, license stream declined from 15.7 in 4Q14 to 16.6, so that decline worsened. Subscription revenue was up. It's up modestly 48.2 to 48.9. So that's one key point. The second key point, U.S. currency is still a challenge affecting the earnings results of the bellwether companies, and it impacts their results in a negative fashion. It also hits some of the ones that are located in foreign countries. And then the third bullet has worsened even more since we created the deck. Perhaps you think of Greece and China. Greece gets a lot more of the press because there's a lot of political theater going on, which seems to be something they thrive on. Well, in China, that consumer economy is going to be rapidly stalled, I believe, based on the asset loss that a lot of the consumers, I believe it's 80% of the Chinese stock market is individual investors, and they have been hurt very badly. We will expect to see a downturn with a lot of attribution to the economic uncertainty coming out in the 3Q15 results, given a lot of this started happening right after the close of the second quarter in June. But it's something that we're looking at, and we do believe it is going to have an impact on performance going forward. Now, the topics we will address after we get through the revenue figures, this is where you'll hear a lot more from Meaghan and Kelsey. This is a key area of focus for these young ladies, is first the rise of the outcome buyer in terms of the application vendor suite and the need for the rebundling of solutions to expand and scale out their applicability. There's also vendors wanting to augment solutions with analytics capabilities. That's something that's going on increasingly. It's also an enticement to get people to migrate to the cloud. The platform vendors such as Oracle and SAP are using that as a way to prove the concept to the install base to see if that can justify the slow roll that we expect to see in the underlying databases as they are able to try these applications or the native cloud applications as a way to determine whether or not they want to drag it through for the analytics that it creates. And then the third point is, it's been around for years, but it's heightening, is the establishment of partners within regions to provide a more local front end or face to the customer in order to expand the presence in those new geographies. And we'll be getting into those after we get into the bubble charts that are coming up. So this one, what this provides you is the 1Q15 application revenue and profitability as well as with the revenue growth. So the left right is the op margin, up and down is the amount that it's grown, and the size of the bubble is the revenue that we're talking about. Now, the key thing that you can see here first, if you take a look at the upper left, those are all the born on the clouds. They've got the great growth rates, and they're not turning any profit. This has been going on for a number of years. It's my own personal belief or curiosity, wondering when Wall Street is finally going to get impatient and start to expect to see profits there. They're all talking about investing ahead of growth. At some point, you've got to start turning a profit on your venture money. Then on the other side of this, you see the multi-lines that are going to migrate to the left. They're going to start having smaller, the operating margins are going to start to decline as those legacy licenses are being flipped over into subscriptions.
Yeah, and to that point, this is Meaghan. One example we've seen recently is in Oracle's recent earnings calls, we're watching their legacy software license and maintenance business runs at approximately a 96% gross margin, whereas as their SaaS and PaaS revenue line grows, we're seeing that operate at about a 38% gross margin. So we'll get into this a little bit more as we get to the subscription revenue slides and the maintenance slides, but we're really watching that, and we think as Oracle grows its base of SaaS revenue, that we're going to watch that 38% gross margin really hit the bottom line for a company that has traditionally turned better profits than most of its competitors.
Right. That's a standard statement now that comes out from Safra Katz and Larry Ellison when they're in the earnings calls, and they're not giving all the information. They talk about $1 a license and what that means over 5 years, and $1 of PaaS or SaaS and what that means over 5 years. But what they don't give you is a conversion that at the starting point, the $1 of license is what, 25 cents, 35 cents to start. And that's a big difference that they're not bringing in. We can give them a little bit of latitude to say, okay, you're investing in data centers ahead of growth, just like the guys in the upper left, but that 38% margin isn't going to go up to 96 by anybody's guess. And I'm not sure how they can keep making that claim, yet they still do. So here's the product revenue. Now what we do here, the next 2 slides will split that. Product equals license and subscription, and then where we have sufficient accuracy, we do disaggregate that to license and subscription, and we'll get into that in a minute. But as you can see here, it's a relatively sluggish area. The revenue growth was about 2.7 when you add it all up. There, I'm sorry, 3.5%. I read the wrong one. It's the top bar that you got to look at. And this is, so they're all kind of clustered in here right around the axis. We've got 2 down there in the bottom there, Totavis and Software AG. Both are impacted by our US dollar conversions from the Brazil real. Mm-hmm. Is that how I say it? Right.
Yeah. Totavis actually did see corporate growth across its segments, but because we present the revenue information for all these companies in US dollars, because of the currency rate that the exchange rate that we use, a lot of the foreign firms such as Totavis, Software AG, and SAP to a degree, although they were helped by their acquisition of Concur, which we'll also touch on later, those companies, their growth was muted by TBR's conversion of currency rather than their own repatriation of revenues.
Okay, if we jump to the next slide, this shows licenses. Now, one other modification we've made to these decks is if we have a negative number for the year-to-year compare, we're putting that as the baseline in a red line, so you just get to see it. So what you can see here is licenses shrank by 16.6%. Microsoft, with a lot of the transformation and conversions of Office 365, is sitting on that bubble. But this is a continuation of the trends that we have been seeing in terms of what has been slowing down as more and more people choose to move to the cloud.
Mm-hmm. And one of the bubbles we're going to watch on this graph moving throughout 2015 and 2016 is Autodesk, which is sitting sort of upper right above the axis right now. And we're going to be watching them because Autodesk is accelerating the transition to subscription only with plans to make all products subscription only by 2016. So they will honor current maintenance contracts and allow customers to continue renewing their maintenance contracts, but for all net new customer additions, it'll be subscription revenue. So we're really going to watch that license base decline and subscription growth move from there.
Now, as we jump to subscription, you can see it's quite a different picture where you have a 48.9% year-to-year compare for the revenue growth. And you also see the bubbles are a lot bigger in terms of the scaling here. And Salesforce quite clearly has a bullseye on its back. It is deemed to be the business model pioneer or exemplar for SaaS-delivered applications. They've been at it longer than anybody else. They, in theory, ought to know how to do it. Profitability still for them remains elusive. Personally, I think if you want to understand how to sell cloud-based subscriptions, you really ought to be looking at Red Hat, who can continually churn out good operating margins while they are on the infrastructure management space. But to me, the better exemplar, in my opinion, is Red Hat, because they're doing it and turning a profit. But this gives you an idea of the stark difference between what's going on with applications and what is going on with subscriptions.
And you can see in the chart at the bottom, this is Kelsey speaking now, you can see that while Salesforce does have its bullseye on its back, growth on a year-to-year basis is relatively, I don't want to say flat, but it's growing slower than the competitors coming up quickly behind it. You can see Microsoft in this chart doubled nearly its revenue on a year-to-year basis, while Salesforce only added around $200 million. Adobe too, close to doubling, and same goes for SAP. Now SAP's does have a lot to do with that acquisition of Concur, and one of the things that I'm keeping an eye on, especially with the ERP vendors, is they're really diversifying their portfolios and trying to scale their revenue by attacking different lines of business. So what we're seeing is a move into the e-commerce space. NetSuite, for example, made acquisitions, Venda in 2Q14, so not quite in there a year yet in terms of this benchmark calendar they have. And then they just also acquired Bronto Software in 2Q15 to build out their e-commerce portfolio. And SAP as well, they acquired their way into the space with Ariba back in 2012, but it continues to be a larger, more strategic part of their applications business. They call it their business network portfolio, and they acquired Concur in December, which I know Meaghan mentioned earlier. And so e-commerce is really an area that we're kind of keeping an eye on, and I'm thinking it's probably going to be a larger area of discussion probably in the next iteration of this benchmark, so you can stay tuned for that.
And in that same vein of acquisitions bolstering portfolios in this area, we see Oracle sort of trailing Salesforce, but Oracle said, in a notoriously aggressive fashion, that they are going after Salesforce and comparing run rates and booking rates. They think they'll be able to overtake them in the coming year or so. And a lot of that is due to, one, their Fusion applications that they've moved to the cloud, as well as their acquired portfolio, especially around Marketing Cloud and sort of the CX suite as a whole. So we're going to be watching a lot of competitors chasing Salesforce, which, as Kelsey pointed out, is seeing much slower growth than some of the other competitors in the space.
Okay. Now, as you would expect, as license revenue is declining, so too, lagging by a year, typically maintenance revenue is starting to stall. In the infrastructure management benchmark we presented yesterday, the maintenance revenue had contracted a couple of points. On this one for applications, it's still up under 2%. It's a little better than flat, slight uptick, nothing too major. But we expect to see this start to decline even further. The only thing that could be solidifying and stalling it is the amount of investment on these legacy applications and how they may be resistant to a massive transformation and change to shift it over. But we also know vendors have been giving their customers the ability to convert or cancel out maintenance agreements before the term expires and flip it over into a subscription base, because the customers are wanting to do this, and it's just a question of how well they manage it. But in the management of it, you're moving from, say, in Oracle's spot, you're going from the 96% gross margin performance over to the 38% margin performance. So the profit impact of what's happening on the maintenance base is going to be severe. One of the flippant colloquialisms for this is the transition from analog dollars to digital pennies and how business models have to transform around this. Microsoft is one of the ones that we believe is managing it about as well as anybody can. But this is a trend that has been going on, and soon we expect to see that year-to-year to compare to wind up being in the red rather than in the green. On professional services, this one is still, it's tepid. It followed about where the rest of it went. It was a 2.6 versus 2.7 overall. There's a lot going on within professional services. Some of it is the automation of services is just is stripping cost out of the model. That compresses the revenue that you see, but it doesn't necessarily have to imply that profitability is being impacted. The deals are typically shorter in length, so there's a selling expense associated with the number of transactions to make up the same revenue volume. But there's clear opportunity for continued professional services within this space, given that there is an acute skills gap for the new technologies that are the underlying enablers of cloud deployment that ISVs, SIs, and enterprise IT have to come to understand and be able to use and utilize in order to take full advantage of the power of the technology that we've innovated. The line I use is that our industry has innovated so much over the last 5 to 7 years that the ability for consumers, enterprise IT buyers, to fully leverage it, the industry's sort of out ahead of its skis here. We've got to slow it down a little bit, and the enterprise IT people have to acquire the skills. So any education and training that a large platform vendor can provide to scale that out will solidify their presence. It'll shore up the install base. This is really the tip of the arrow in a lot of respects based on the volatility that we're seeing inside the market.
Yeah, and one of the interesting things, I'll just call out Workday here on this graph. They're off to the right, and what I think is interesting about them is every time they launch a new suite or a new product, we see higher growth in their professional services, and this is because Workday prefers to keep their professional services in-house on these newer products until they've come up with sort of the best practices around integration and deployment. This is a tactic they use to keep customer satisfaction and, in turn, customer retention high. So rather than launching a new product and giving that straight away the services opportunities to partners, they train their partners up first, come up with best practices, and then once they're at a sort of comfortable either customer count or number of deployments, they will increasingly funnel more and more opportunities around that product to its ecosystem.
Okay, with that, we will move over into the overarching themes. The first one being the rise of the outcome buyer and the applications vendors to bundle the solutions. And that will be Meaghan. Oh, no, I lied. That will be Kelsey.
Thanks, Geoff. So TBR research has shown that customers are increasingly identifying themselves as outcome buyers, and that they also expect this identification to continue skewing even more towards outcome purchasing in the future. So when I say outcome buyer, I really mean customers that want to purchase complete solutions that provide some type of business outcome, as opposed to a customer that prefers to build their own results, buy piece parts and put them and integrate them together themselves. So we're really talking about the ones that purchase, want to deploy, and get the outcome right away. And so applications vendors really have to keep these outcome buyers in mind, especially business applications vendors, because line of business buyers are the ones that most often identify as outcome buyers, whereas the IT department is more okay with having to piece together a solution, and in a lot of cases they would rather control that portion of the process rather than having the vendor do that themselves. So to cater to this buyer type, applications vendors are taking some of the IP that they've generated from custom engagements where they discover different business challenges for specific lines of business or verticals, even geos, and then create repeatable frameworks that address these challenges. So really what they're doing here is taking their existing technology that's already in their portfolios, taking their strengths in certain segments, and then rebundling those technologies and strengths to create one holistic solution. And the key piece to this, I think, is really the seamless integration, because, like I said, customers don't want to have to figure out how to integrate these pieces themselves. It's not just packaging up products and selling them together and saying, okay, buying all of these offerings will help you achieve your outcome. It's really buying this solution, you implement it, and your outcome is there. So that's really where we're coming at this from a customer perspective. From a vendor perspective, bundling solutions together really helps applications vendors extend the applicability of their existing technology while also creating new monetization opportunities for that technology. And this is a great strategy for some of the players that are struggling with margins, which just happen to be a lot of them at this point. You know, the pure plays that haven't made positive margins yet, and the traditional players that are moving to increasingly subscription-based portfolios. This is a way for them to remonetize what they already have with little additional R&D investments. So if we take a look at some of the specific vendor examples, Salesforce is the first one on here, and I think they're kind of one of the more interesting cases. They launched Salesforce for HR in April, and basically what they did was take some of their core line of business applications, so in this case Marketing Cloud and Service Cloud, and then combine them with their strengths in social, so pieces of their Community Cloud, Chatter, and then their new kind of foray into analytics. And what they're doing is providing the collaboration and the communication aspect to the HR function. So taking their existing assets that they already have, which are largely tailored to, you know, the customer-facing front office functions of an organization, and making that technology more applicable to back office workloads like HR. And, you know, while I don't think that Salesforce is going to move completely into the back office space anytime soon, they now have kind of slid their way in, and they're really extending their reach across more of customers' business processes. And if you think about different arms going out, they touch pretty much all the front office functions, and now they've got that arm extended in the back office. And they can do this with other back office functions as well. And, you know, the partnerships that they've formed with the HCM vendors, such as Workday and SAP SuccessFactors, Oracle's Taleo, those partnerships are really just going to help them move into this space without encroaching too much on those partners' businesses. So it's definitely a unique way to rebundle and extend their applicability. Now, Workday is the second one on here. And Workday took more of a vertical approach in this rebundling strategy. So they take their core HCM and financial management offerings, again, bundling in analytics, and Meaghan will talk about this. This is an increasingly large value add to line of business applications. And they're really capitalizing on their strengths in the people-focused workloads like HR, and they launched Workday Professional Services Automation, which manages the professional services firms and the professional services arms for technology companies, managing those billable projects. So again, the functionality of this is really nothing out of the ordinary from what Workday was already capable of doing, but they are now packaging it in such a way that it provides a direct outcome to a specific set of industries. And this is the same strategy Workday used when it launched Workday Student for higher education industry, and in both cases, take existing technology, maybe add one or two bits of specific functionality that caters directly to that industry, and going to market with that full outcome. So to kind of recap, that was a lot of information. Customers are increasingly identifying as outcomes buyers, wanting to purchase holistic solutions out of the box that meet specific or solve specific business challenges they may have. Application vendors are addressing this by rebundling existing technologies to provide outcomes to specific lines of business or verticals, while at the same time extending the applicability of their existing portfolios. So with that, I'll hand it off to Meaghan to discuss the next topic.
All right, so in this topic, we're going to be talking about how vendors are augmenting with analytics. And as Kelsey discussed, a lot of vendors are rebundling their existing products to differentiate by offering comprehensive solutions. But many vendors are also looking to add incremental value with analytics. So augmenting solutions with analytics capabilities differentiates vendors in the highly contentious market by offering a greater value proposition to customers, as those customers migrate to cloud and are often reevaluating which vendors they use for their applications. So As vendors remain challenged amid the industry-wide shift to the cloud to retain legacy customers while also growing their install base, by coupling the assurance of painless migration to the cloud with embedded advanced analytics, those vendors will be able to drive increased value for customers and lead to not only retention of their customer base, but also the attraction of new customers. So some of the key vendor developments we've seen recently that jive with this, the first and what I think is sort of the most interesting is IBM with its Watson IP. I'm sure all of you are aware of Watson's beginnings, becoming an established as an innovative artificial intelligence solution back in 2011 by winning Jeopardy. Watson is a question-answering computing system which is built to apply advanced natural language processing to observe, interpret, evaluate, and decide the same way that you and I would, but with much greater efficiency. So essentially it creates what IBM refers to as a partnership between people and the computer to supplement human decision-making. Now, IBM is reorienting and differentiating its software value proposition through new Watson-branded industry solutions. So this, again, ties back to what Kelsey was talking about really focused industry solutions, which can leverage not only Watson's capabilities, but also the established ecosystem of partners and developers that surround the unique product. Currently, there are Watson applications for industries ranging from healthcare to retail, and you can also develop applications with Watson services to leverage the cognitive computing power in concert with your specific business needs. Along this vein, in 1Q15, we saw IBM launch Watson Health. The Watson Health unit has 2,000 dedicated healthcare-focused professionals and a HIPAA-compliant community cloud offering, which is Watson Health Cloud. And that's enhanced by partnerships with Apple, Johnson & Johnson, and Medtronic. So with the launch of the Watson Health unit, IBM follows a pattern that delivered success across the original Watson unit that was established a little over a year ago. And for IBM, the commercialization of Watson IP is key to success for IBM's new software offerings, as it will provide the differentiation and integration opportunities that customers will see as a differentiator, will see as making IBM's software solutions unique. So IBM's recipe for success here is injecting Watson IP into the industry-specific solutions and quickly spinning up an ecosystem of partners and developers around that particular industry. So moving on, again, tying back to the out-of-the-box solutions for outcomes buyers that Kelsey was talking about, we saw SAP aim to put analytics sort of in the hands of all user types by broadening the reach of its analytics portfolio to meet the needs of different users. In March, SAP merged their predictive analysis tool, which is traditionally a very complex data mining solution that was tailored to data scientists, and they merged that with Infinite Insight, which came out of a 2013 acquisition and was designed for business users. It was an automated predictive modeling building process, and by combining those two solutions, they created SAP Predictive Analytics 2.0. By combining these solutions, they appeal to both business users and data scientists by providing a greater value proposition for LOB buyers who are becoming more involved in the IT purchasing, again, as Kelsey talked about earlier. In addition to this, SAP launched an on-premise SMB edition to its Lumira data visualization software called Lumira Edge. To make this solution affordable to SMBs, Lumira Edge is offered on Windows servers instead of SAP Hana and limits the number of users per customer. But again, this targets sort of a segment of buyers that has different needs. Another vendor we're seeing add a lot of analytics to their solutions is Oracle, who's building out their cloud portfolio very rapidly. As part of that, they have Oracle Analytics Cloud, and they're using that to sell a more integrated cloud solution across their CRM, HCM, ERP, and supply chain management suites, all of which have their own analytics offerings. So in conclusion, while competitors are lacing their products together to create solutions for outcomes buyers, they're also augmenting those with analytics to further differentiate themselves from other vendors in the market.
Right. As we move, what both of these themes that Meaghan and Kelsey have been talking about is, from my perspective, is simplifying the adoption that's required for the enterprise IT stack, be that it's integrated together, be that it works on the same infrastructure, be that you can move it, you can have it on-premise, you can have it in a private cloud local, you can have it private hosted, you can have it in the public cloud, et cetera. The underlying infrastructure will, in a couple of years, no longer be a consideration. It will truly be just, where do I plug this in? And that component of it was really what Meaghan was, what Kelsey was talking about. And then as Meaghan was getting into it, it's really the move. Analytics is here. Analytics is the accelerant for this industry transformation that we're seeing. I've been around to see a few. I was taught the mainframe consolidation from my mentor. I lived through minis, et cetera, on up through the stack. Saw the dot-com implosion, start looking at cloud companies, wondering if we're not ready to get into another one. But the accelerant, the reason why the time it's going to take for this industry to just kind of reshape itself is going to be a lot faster because of analytics. So you see these things that they're talking about here. Now, if you jump to the next topic, well, we're talking about all these different ways that technology is being bundled and baked and simplified to make it easier to consume. At the end of the day, it still comes down to a person-to-person interaction. And what is happening with that is this need, it's always been there, but it was there more for regional partnerships, and you see it quite a bit with the market in China, the idea of indigenous IP, the desire China has as a country and a culture, I guess, for lack of a better word, to have that IP stay in country. So that's one reason why you need it. The other thing that's coming up is we've seen as an impediment to cloud adoption, it's been security. We've heard about that for, since 08, 09, when this really started to accelerate. We're also seeing more and more about the data sovereignty and the local company presence. So from that perspective, a line I've used on this for quite some time is the idea that IBM is big enough to go small. And by what I mean by that is they have enough working capital and they have enough scale. They can drop data centers in just about anywhere. And they broadcast, I think they're talking about how they now have 60 of them around the globe. That has the benefit of, do you bring the application to the data, or do you take the data to the app? As data sovereignty is a bigger and bigger issue, you're going to need to be bringing the app to the data, particularly when you want to run analytics on it, and then worry about the local country laws around privacy and all these other things. So partnerships with in-country or in-region third-party vendors are going to be increasingly critical as a way to sell the products now that you've stitched them together based on the need for this, what I'll call the local human interface. So the examples that we see here as we talk about it is SAP Anywhere and a new front office SME solution that's available only in China and developed jointly with China Telecom. So there's an example of a local country, or I'm sorry, a local business taking lead, and then the underlying technology coming from SAP to be able to bring that up. The other piece to see that's of interest, this is on the more traditional way. NetSuite has appointed a seasoned channel exec, and Graham Bird as a channel sales director for APJ. That's the more conventional route that you're going to see the cloud companies start to build out, the born-on-the-cloud vendors, and that kind of follows the playbook that was deployed for years for distribution and everything else, which was typically you may have sold a global deal, you had some equipment shipped to a certain country, you needed to put a field service group there to maintain the product sets. Therefore, you might as well bring up a sales guy. You went out and you established an exclusive distribution deal, and they were the ones that did all the selling work for you. Over time, you might then build out your own sales force directly. But we're seeing more and more of this, particularly with these emerging born on the cloud and application vendors needing to extend their reach into the emerging markets. Now with that, we have a few minutes for questions. We'll open the lines to see if there's any burning topics you want us to discuss. Justin, are there any up already?
Yeah, all right, and yeah, just a quick reminder, please send any questions to the Q&A function. So we'll start here. As customers look for trusted advisors, what SIs are best positioned to help them?
Trusted advisor SIs. Well, that one is there's the enterprise grade SIs, which would be the traditionals, the Deloittes, the McKinseys, the PwCs, Accentures. What we see on that end, as we're looking at the cloud, well, there's two things going on. There's cloud delivery models, and there's the power of analytics. On the cloud delivery model component, that's really more of kind of an infrastructure transformation play. The enterprise individuals need to understand what they can do or be educated on the new types of infrastructure tracking and maintenance management, billing, metering, provisioning, all the gobbledygook that's in there to allow for the buildbacks and the rapid deployment and shifting of application workloads from an on-prem or private cloud deployment up over into a public or hybrid managed service. So that's one element of it. That lends itself, an IBM where they have a strong presence in there with global GTS has a very good play there. HP has a very good play there. Dell's coming up. Now when you look at analytics, to jump, that one is much more of a strategy-led engagement because the way in which business can organize itself or the new business streams business can generate with a digital services economy, as people are talking about, they really need a business process engagement to take a look at the overall operating strategy and how businesses can organize, which will be different. It won't be as siloed. And that really plays into the McKinsey, the Accenture, the Deloitte type of tier. That hits the big enterprise. Now you've got the whole global mid-market where a bunch of strong regional players, I should say, the Capgeminis, the CSCs, the Atoses, they're going to be able to come in at that mid-market area. The challenge will be that the selling effort to do the education of what can happen, the revenue dollars aren't going to be there to justify the selling expenses, so they've got to find a way to work with the partner community to drive that down and be able to deploy it. Now, do you see here that these transitions from device to user-based licensing models are driving more and more publisher audits? I have to apologize and say I'm not sure what is meant by publisher audits. Well, we can move to another question. If they can clarify that question, I'll happily answer it. All right, after all is said and done with the move, what will be the percentage? Subscription versus on-prem. What will be the percentage of Fortune 500s that will be subscription versus on-prem? I asked that question a little bit differently at Red Hat on this one, and where I was going with it was I was looking at containers versus virtualization, and if you use containers, do you need virtualization, and what does that mean to VMware? And the response that came back was really the notion of there's two different things that you have going on, right? You have native cloud applications being built for the cloud. Then you have on-premise cloud, on-premise cloud, that's good. On-premise apps that are being modified or retrofitted to move to the cloud. So I believe it was Bob LeBlanc at the IBM Cloud Summit that I was at that made the distinction between born on the cloud and born in the cloud. So you can put a legacy app on the cloud, but the new apps are built in the cloud. So the answer to that question is, I'm being very long-winded here, is it's going to be a workload migration as to what's going to happen. It's more of sort of a seesaw. And if you have bespoke applications that are mission critical, they may very well stay on-prem or they may stay in a private cloud environment. and what's the difference between a captive private cloud and on-prem, you know, maybe that's a distinction without a difference. But then now think of the systems of engagement that are the new powerful applications that cloud enables, mobility enables, digital enables. The more that you're working with systems of engagement, the more those will be cloud enabled and cloud delivered, because you've got to bring the compute closer to the endpoint, because the endpoint is both the data capture, what's going on with the smartphone as a platform, and it's also where the information is, it's where the user wants the information imparted, I guess is the way to put it. Yeah, no, go Kelsey, sure.
Yeah, so when I read this question, my gut reaction was that the answer is 100% both, because I think what we're seeing, and we have a hybrid cloud customer research that we do, and what we're seeing is that hybrid environments, whether that's hybrid cloud or in a lot of cases it's hybrid IT, so combining cloud and on-premise, hybrid is really the end goal for a lot of organizations now, and it's not so much, they're not so much hybridizing because they have to. Hybridization is their plan from the get-go in a lot more cases now than it was previously. So I think what we're going to see is that those Fortune 500 companies are really going to have a bit of both, and keeping core workloads, whether that's ERP for the manufacturing firms, that may stay on-prem or in a private cloud, and then moving some of the secondary workloads like CRM or even HR in some cases to the cloud. But I think that's why integration is super important and becoming even more and more important, and why we're seeing vendors partner with competitors in a lot of cases is the need for integration across cloud to cloud, cloud to on-prem is increasingly mounting.
Right, I think that, just to amplify that, we're still not really giving you an answer that subscription be on-prem, because what is going to be on-prem? And the point I want to make there is, as we're looking at OpenStack, we did a little bit of extra research on that after the two acquisitions, Blue Box and Piston, on the same day by IBM and Cisco around this piece, was really that there was somewhat of an unintended consequence to the OpenStack layer. It was designed kind of as an Amazon killer, and what happened is it pivoted into the private enterprise, because the private enterprise wanted to establish an infrastructure layer that would facilitate the movement of workloads back and forth between I'll call it an on-prem private environment and a public cloud environment. And that just goes back to the notion of the increasing demand for simplicity as the underlying fabric for whatever application is going to lay on top of it. Now, the next one we have, this is one of my favorites. You've shown Salesforce gross trading compared to closest competitors, despite large S&M expenses making their op margin very, very low or negative, value-added or negative. In this context, do you think the financial community could change their mind on cloud players all based on growth? The first thing I would say is, by God, I hope so. But yes, I think at some point you got to start turning a profit. I have a friend in the venture community, VC guys. They read the executive summary. If they like the executive summary, they go to the back to look at the biographies of the key principals to see if they've done it before, and then they start to read the body of the prospectus. And as this gentleman said, as you're looking through it, you're always looking to figure out, where do the snakes come out? And by that they mean, you know, what's the big leap of faith you have to make to think that this is going to work? And where the snakes come out on cloud companies, in my opinion, and I'm pretty passionate about this, is this notion that the renewals will be add to cart. They've got all this upfront selling expense. It was the missionary selling of why it's okay to go to the cloud, but hey, we're going to make it up on the renewal. The only way they will make it up in the renewal is if they know when to take that lever of the large sales staff that's the big piece that's bleeding them right now, and know how to either turn it off and start laying those bodies off, or have enough scale that they can justify it. But if you think of the politics within organizations, and sales and marketing usually has one of the biggest sticks at the table, the idea that, hey, I've got double-digit sequential gains, and you're telling me I've got to cut my staff, well, that's going to be a hit. So I do believe that the run-up here we are ready for a Wall Street correction on these things, in my opinion. And Meaghan, do you have something here?
Yeah, so in that same vein, I really, again, covering Oracle very deeply, I personally think that Wall Street watching the traditional software vendors migrating to the cloud and watching their margins erode versus the cloud-native companies who have sort of started with negative margins and continue to hold those negative margins. As Wall Street watches sort of the Oracles and Microsofts migrate their license base to subscription, as their traditionally high margins erode, I think that's really what's going to start throwing a lot of red flags. And again, bringing it back to the sales and marketing expenses, those companies that have traditionally had the large sales staff to sort of sell the traditional solutions, again, they're going to need to start making their operations more efficient in order to compensate for the lower revenue and lower margins per product.
Right. If you wanted to take a look, or if I call this a planning question, if you ask me who should we look at to try to read through the 10Ks and Qs to understand who's managing it well, the two I would point you at are Red Hat and Microsoft. Microsoft, because what they were able to do with Office to Office 365 is really, really, they've managed it extremely well. I don't know if Nadella needs the credit here or what, but they're doing a very good job with that. And I think the reason they were able to do this is they were already used to kind of volume end-user support, because what they were migrating was already out on a laptop or a desktop. It wasn't an IT-controlled kind of application layer. So it was a simple shift. It was just a monetization strategy shift, whereas if you're sitting there with some very data center heavy application, be it a database, be it something else, it's a tough lift to take it over from on-prem up and into the cloud, where you've got virtualization layers and all sorts of software-defined components that have to be analyzed, monitored, and the people who are supporting it either in the vendor or in the business have to learn new technologies and new skills. That's a tougher hurdle. So that's one that's done a good job. Now, Red Hat did a great job with this, because essentially they built a business around a free application, and all they sell is the enterprise-grade support that they sort of industrialize from open source contributions into these services. And they've managed it very well. They also haven't had to worry about killing the fatted calf too soon, meaning slitting the throat on the license and maintenance gross margin to 96 to bring it down to 38, which is sort of where Oracle is going to teeter and some of the others will teeter.
Right. I think we have one final question here. What are your sentiments around S/4HANA and the implications on the applications market?
Who wants to lead?
Yeah, I can. So I think for S/4HANA, there's still a lot of hesitancy, I would say, around, the migration time and the cost of migration. I should clarify, so for existing SAP customers, those that have Business Suite, and even better if they have Business Suite on HANA, the migration and the cost isn't as high as if SAP is trying to recruit net new customers to adopt HANA. Again, and if you're not an SAP customer, then S/4HANA comes with the clause that now you're on an all SAP stack, so all SAP applications, HANA, the database on bottom. So I think while I believe it is a transformational solution, and the implications around analytics and kind of a more integrated business process, I think that the migration challenges and the costs are going to slow the rate of adoption, at least initially, until there are some real customers out there that can be touted around as proof points for the viability and the real business transformation outcomes that HANA can provide.
And to that same point, I think going sort of back to the trusted advisor and service partner thing, is if there is a services partner that can form a strategy and sort of a roadmap around making the migration to S/4HANA less painful and less costly, especially, again, as Kelsey noted, for those customers that aren't on SAP products yet. I think that will definitely accelerate the adoption and enable customers who would shy away from S/4HANA because of the pain of transition and the cost to really embrace that business transformation.
This is a classic example of the point I stumbled through about saying the industry was out ahead of its skis. Take a look at ROI versus TCO. If you don't fully understand what's possible as a result of in-memory analytics capabilities, if you haven't fully comprehended or been proven to you from either an SI or from your own test cases what is possible, you're not going to assign enough value for the ROI equation, and you're going to fixate on the TCO of what the rip and replace is. So as I stated, Microsoft, and it's a simpler lift. I'm not criticizing when I get to Oracle and SAP on this, but Microsoft's been able to do that very easily with Office 365 because it's a rather simple shift. But when you're shifting from a traditional structured database into an in-memory database and then feeding in unstructured data feeds, that's a much bigger rip and replace. There's a lot of legacy investment going on there. So what you see that both SAP and Oracle have done with a fair amount of success is they have the bolt-on modules that are cloud-enabled that use the in-memory analytics capability. It serves both as a ring fence for the installed base. They can sort of trial it out. At one of the vendors, they had customer use cases that had migrated to the Marketing Cloud suite, and every single one said the reason they selected that vendor is because their legacy application was with that vendor as well. So they might as well trial it out on a subscription basis. They can see the power of the in-memory analytics. It's backward compatible with what they have. So it defends the installed base. It gives them a trial as a migration up and over, and it can also serve as the tip of the arrow to try to get in and around some of these others, because when you start looking at the application layers that are heavily tethered to the 300-pound gorillas in the database space, that's a big rip and replace. That will be a slow roll, and all the vendors are racing to message out how simple that transformation will be while trying to educate to help with the ROI component of what else you'll be able to do and inform your business and increase your time to value and create new business revenue streams. And that's an education process where the strategy-led consulting firms have a very powerful role, particularly for the enterprise. The challenge then becomes how do you drive that and scale it down market to the mid-market space.
All right. Oh, that's all we have for questions. So thank you, Geoff, Kelsey, and Meaghan. Thank you, everyone, for your questions today. You can follow the Analysts as well as TBR on the Twitter handles listed here, as well as emails to reach out if you have any questions about the application software benchmark. Just a reminder, I will be following up tomorrow afternoon with all of you with the link to the recording from today's presentation as well as the slides. Additionally, before you sign off, there's a quick survey that pops up. If you wouldn't mind filling that out, we're always looking to improve both the information we share and how we share it with you all. So we'll leave the chat function open for another minute or so for last minute questions. Otherwise, thanks for attending and have a great afternoon.